Hi, welcome to Market in a Minute. No, I'm not at the Strait of Hormuz. I'm actually in Costa Rica, so checking on a couple of my investments. I think it's really important as a money manager that you track all the data points as you go along. You gotta build that record of understanding how the market's getting to where it is, what the market's thinking, and why it may be just completely wrong. So it's important to be able to see around the corners, right? To get positioned properly. So we're seeing around the corner, and we think that probably 2027 is going to be a really good year in terms of further economic growth. And when the market decides that it can see that visibility, then it should have a pretty darn good move. In the short term, I think everything's clouded for the overall stock market. What we want to do is compare what happened in 2022, because that's the last time oil got above 100, with what's currently happening. I think there's vast differences, some similarities, but vast differences. So if the Strait of Hormuz is blocked, that's a big problem for energy prices, oil prices. So we want to review the fundamentals and the technicals and see if we can see that visibility yet into 2027. So disclosures, please read those when you have a moment. Market update. So 4 key points. We've been saying this over and over again. We expect more volatility this year. Could be a 20% correction, or I guess you call that a bear market. But we see more volatility this year. Could be as much as 20%. Valuations are high because of what the cumulative effect of technology. The technology stocks performing have stretched the market quite a bit in terms of PEs. 48% of the overall market's in tech, which is a obscene, crazy level to have all that exposure. And there was a reason for it. The Federal Reserve choked off the economy and nothing else had a chance to grow. We think that's changing, so we're looking around the corner a little bit. We see that the first signs of that actually starting to develop where we can get really good performance out of those other sectors of the overall markets. So when you look at valuations, they're high. They're down a little bit, 21 times now versus they were 22 plus. So they're down a little bit, but they're far higher than what they were in 2022. Valuations high, expectations high, so the expectations this year have to be met, otherwise the market's going to sell off. So we've benefited from 3 years of double-digit returns in the overall stock market. It's hard to get a fourth. So our view is we're probably going to see a pullback, maybe more than what we've seen so far, and then a really nice rally as we can start to see interest rates coming down and a good outlook for 2027. So the rotation last year has been good. The rotation, we saw that our theme playing out. Beautiful. Some stocks perform really, really well. So we think that will continue at some point this year and into 2027. What's happened with the war of Iran, okay? Oil prices spiked, which gives this Federal Reserve the excuse to do nothing. So what if oil prices dipped quite a bit, back down, and then the tariffs already are kind of locked in there? We know that scenario at this point. The Federal Reserve is going to have no other excuses but to cut rates. Probably happens under new leadership of the Federal Reserve in May. So we think that sets up for maybe a number of different cuts as we go through the second half of this year. That's clearly not in the overall markets. Now it's kind of odd, okay? I think this is an interesting call. So this is from Ed Yardeni, who's a perpetual bull. He's calling for a 30% chance of recession. So maybe he sees the oil issue differently than we do. We don't think we're going to get a recession off of oil prices. They have to go really materially much higher for that to occur. So we're kind of looking at it the other direction, that this is not going to last an extended period of time, and oil prices they're going to drift back lower. So the bottom line of this is the war with Iran. If you handicap it, you go back and look at other wars, maybe that would be similar to this. 3 to 5% pullback. That's about all you get. And we've had that 5% pullback from high to low. So the market, to some degree, has discounted that already. I don't like how the market's doing technically. So we've talked about this. So you can see over here that we've had a number of different times where we just couldn't break above, that 6970 level, or close to 7,000 on the S&P. Just couldn't break above it. And we broke the bottom end of the support line. So the bottom end of that channel, which is 6,800, we've tested that over and over and over again. We thought we'd break down below it, and we did. And with the announcement by Trump saying that the war with Iran may be about over, which is, to abbreviate some of his comments late in the day on Monday, the market rallied back close to that 6,800 level. So we think maybe if it breaks above 6,800, we can maybe take a shot at 7,000. Wouldn't count on it. We don't like the markets below 6,800. We want to be more defensive, okay? So we're being protective of our clients' money. I think it's important below that 6,800 as is breaking the trend line. And we're holding more cash than probably normal, having a hedge in the portfolio, more defensive assets in our overall portfolios as well. I want to point out, that the market has huge trust in Trump. If Trump says it's time to buy, or he says the war's over, or he says we're going to protect the Strait of Hormuz, the market's going to believe it. Now, the risk factor, the VIX, you can see it on the bottom right-hand chart, it got high. It got over 30. So it did a number of times back in 2022. It spiked up in a big way in 2025. But we think it's at a level that is starting to discount some of these negatives. Margin debt. Okay, I just want to point out there's all sorts of less predictable money out there. Money that's going to have to run for the exits in case something happens. So you can't lose a lot of money on margin. So it's quick money. It's money that's going to have to protect itself if the market falls. It's basically at an all-time high, margin debt is. And, the markets are pretty lofty as well. So that the red line there is the market cap of the Wilshire 5000 versus the blue line being margin debt. So kind of disturbing. However, we don't think it's a huge issue, but it's something that we just need to be aware of. Okay, comparing 2022 with what's happening currently. So it's crazy on Sunday night watching the futures trade on oil. They got up to 100, close to 120. The Asian markets were cascading down. They were coming apart, and kind of the setup was for the Monday morning to be really ugly. It wasn't. It was a little bit ugly, but it wasn't really ugly. And the markets came back, late the day on Monday. So the market's kind of buying into what Trump said about maybe this coming to an end. Obviously, Iran has no defenses at this point. Everything's been killed except for some of their leadership, which probably will continue to occur over time. Big difference this time is that oil started at a much lower level versus in 2022. So the percent increase is bigger. However, we don't think that the impact will be anything significant on the overall economy at this point. And with the Russia-Ukraine war, it went up before it started in a big way, and then after it occurred, it kind of, it went up close to 120, but pulled back down over time nicely. And the overall markets understood the Russian oil wasn't going to be completely shut off, being 10% of the overall global supply, that's significant, but it didn't end up being a big deal. Iran is only 2%. So the Strait of Hormuz is 20%. So that's where the problem is in the overall outlook for oil prices, is that 20% exposure through that strait. And with the U.S. military being there, we don't think it's going to last that long. Maybe another week or maybe shorter, but that's going to be reopened. So a month from now, we can probably see oil prices down significantly from where they are currently. The economy was so much different now versus then. So back in 2022, you had a Federal Reserve. Check this chart out. The Federal Reserve was raising interest rates, raising them like crazy. Okay, so that red line there is the direction of interest rates going up on the federal funds rate. They were so far behind, they had to do something, even in a declining overall economy. The economy declined 1.6% in the first quarter, 0.6% in the second quarter of 2022. It was a technical recession, and the Federal Reserve was raising interest rates. They should have been raising rates much before that, and then bringing them down as the economy cooled off in 2022, not keeping them at such a high level for so long. The valuations of the overall markets, okay, you can see here the blue wings. We got down to 16 times earnings in 2022, down from roughly 18 times earnings. Could we go back down to 16 times again? I doubt it. I don't see it this time. Could it go to 18 times? Yeah, we could get our 20% correction that way. Maybe it goes to 20 in the near term. 20 with the valuations in the overall tech market, that really gets us to 18 times. So maybe the downside isn't as large as it appears when you look at the valuation of the overall stock market. Now, when Russia invaded Ukraine on February 24th, you can see the market dropped another 18% from that point to be down from the high roughly 21%. Okay, so that was quite the decline that had occurred. Again, Russia really wasn't the issue behind it. It was the Federal Reserve raising rates when the economy was weakening. Most economists thought there was going to be a recession. We're not buying into Ed Yardeni's call for a recession this year of 30% chance. Maybe that is the reality of all years, but we don't see a big probability of a recession coming in 2026. Actually, we see growth picking up as we go through the year. So what we want to see is visibility of 2027. When Powell was going to be indicted for fraud because he's an idiot, he can't build a building at budget. That's not fraud, that's just being an idiot, right? So when that occurred, we got defensive. We didn't like the setup to start with. So we got defensive. We put some hedges in the portfolio, started to raise some cash. The markets pulled back, roughly, like I mentioned, like 4 or 5% from that level. The technicals aren't set up very good right now. They could improve probably significantly. But as it's broken below 6,800, we want to be more defensive. 6,800 on the SP, we want to be more defensive. It could kind of take some time to keep going sideways or start to improve as oil prices come back down. If oil prices crash back down, then we're going to get in because 2027 is going to look fantastic with lower interest rates. So just keep that in mind. So our view is that this may take a month or so more. We're going to go sideways with volatility. When the new Fed chairman comes in place, he'll set things up to cut rates as we go through 2026. 2027 will look better. We want to find a nice opportunity to deploy some of our money into that rotation part of the market. The value, large cap value, small cap stocks, income oriented stocks. So things that are more cyclically oriented and we want to own some technology too. Did you get into Marvell? So that was our second shot to buy it. We trimmed back our Texas Instruments position, bought Marvell. That worked beautifully. Marvell's quarter was really nice. Marvell is like the Rodney Dangerfield, MRVL, Rodney Dangerfield of technology. At some point, it's going to get its respect, and it's going to get a very nice multiple on it. Hopefully, it goes significantly higher from where it is currently. So that was our play the last few weeks, trimming our Texas Instruments into Marvell, and just generally being more conservative in our overall portfolios. Come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. We'll send that to you every week. And also, I think it would be good for investors that are looking for defensive strategies that also can step on the accelerator and really make some good monies in up markets. So loss averse is what we call it, investing, where we want to protect our clients' money in down markets, most importantly. If you protect them in down markets, the rising markets become so much easier, and you can really compound money very nicely if you protect the portfolios in down markets. And we need that visibility of 2027 to have any significant rally in the overall markets. Thank you very much.